decades, the US dollar has been far more than a simple medium of exchange. It became the central axis of the global financial system, the reference for international trade, central bank reserves, and the pricing of the world's main commodities. The dollar symbolized stability, predictability, and power. Regardless of the crises the United States faced throughout history, there was always a sense that the American system could reorganize itself and move forward. Today, that perception is beginning to change. Quietly, but consistently. The recent depreciation of the dollar is not an isolated technical move, nor a temporary market adjustment. It reflects an accumulation of economic, political, and institutional tensions that have been deepening for years. Since Donald Trump's return to the presidency, the U.S. currency has come under increasing pressure, recording a decline of nearly 10% over a relatively short period. For many investors, this figure matters less than what it represents, a warning signal issued by the market itself. The weakening of the dollar comes at an extremely sensitive moment for U.S. public finances. The country is grappling with persistent fiscal deficits, record levels of public debt, and a growing inability to build even minimal political consensus to address these structural problems. The government consistently spends more than it collects, financing the gap through the continuous issuance of debt. For a long time, this strategy worked without major consequences, as the world was willing to buy U.S. Treasury securities even with low returns, trusting in the country's institutional strength. That trust, however, is no longer automatic. Trump's return to power adds an extra layer of uncertainty to the outlook. His unpredictable approach to economic policy, aggressive rhetoric toward traditional institutions, and frequent clashes with regulatory bodies create an environment in which markets struggle to anticipate future decisions. For global capital, predictability is one of the most valuable assets. When it is lost, even partially, perceived risk rises, and the dollar feels the impact. At the same time, America's fiscal challenge has ceased to be merely a long-term issue and has begun to influence present-day decisions. Public debt continues to grow at a rapid pace, while political debate proves incapable of producing durable structural solutions. Each new spending package approved without clear offsets, each congressional deadlock, and each threat of a federal government shutdown contributes to the gradual erosion of U.S. fiscal credibility. This erosion does not trigger immediate collapses, but it does shift expectations. Investors begin to demand higher premiums to keep financing the U.S. government. When that demand emerges, it is reflected directly in the currency. A weaker dollar is, in essence, a sign that the market is recalculating the cost of trust. Another central factor in this process is the changing global landscape. The world that consolidated dollar hegemony after World War II no longer exists in the same way. Today, major economies are seeking to reduce their dependence on the U.S. currency, whether for geopolitical reasons or economic strategy. So-called de-dollarization does not occur abruptly, but advances slowly through bilateral agreements, reserve diversification, and increased use of alternative currencies in international trade. In this new environment, any internal instability in the United States takes on greater significance. External perception shifts towards seeing the country as still powerful, but no longer untouchable. Extreme political polarization, recurring institutional conflicts, and difficulty implementing structural reforms directly undermine the image of predictability that has long supported the dollar. The independence of the Federal Reserve is another sensitive point. Historically, the U.S. central bank has been viewed as a pillar of stability, capable of making technical decisions even under intense political pressure. When doubts arise about that autonomy, confidence in monetary policy is shaken. If markets begin to believe that decisions on interest rates, inflation, and liquidity may be influenced by short-term political interests, the reaction is immediate. Perceived risk increases, and the currency weakens. It is essential to understand that the dollar's decline does not, at this moment, represent the end of U.S. economic leadership. The country still has the deepest financial markets in the world, highly innovative companies, and a unique capacity to absorb economic shocks. What is at stake, however, is the cost of that leadership. Sustaining the dollar's central role requires fiscal discipline, institutional stability, and political coherence. When these pillars begin to show cracks, the market responds. Financial crises rarely begin with dramatic, visible collapses. More often, they start with small signals, gradual movements, and reassuring explanations. a currency that falls slightly more than expected, debt that grows without a clear plan for containment, political tensions that recur too frequently. Everything seems manageable until it no longer is. In the current context, the weakening of the dollar should be interpreted as a symptom, a sign that the U.S. financial system remains dominant but is no longer immune to its own contradictions, a system that increasingly depends on global confidence while facing deep internal divisions and ever more difficult economic choices. When the U.S. dollar weakens, the impact is not confined to the borders of the United States. Quite the opposite. As the world's primary reserve currency, any significant move in the dollar triggers a domino effect that crosses continents, markets, and entire economies. The recent decline of the U.S. currency is beginning to reshape global financial flows, altering investment decisions, central bank strategies, and even the cost of living in countries far from Washington. The first effects appear in international financial markets. A weaker dollar changes the logic of capital allocation. Global investors begin to reassess their positions in dollar-denominated assets, especially U.S. Treasury securities. For decades, these bonds were considered the safest asset on the planet. Today, they remain relevant, but they are no longer treated as absolute zero-risk instruments. When that perception shifts, even subtly, the balance of the global financial system starts to move. For emerging markets, dollar depreciation brings temporary relief, but also new risks. At first, local currencies tend to strengthen against the dollar, easing pressure on external debt denominated in the U.S. currency. This can relieve public finances, improve fiscal indicators, and reduce import costs. However, this benefit comes with a more unstable backdrop. If the dollar's weakness is tied to deep uncertainty in the U.S. economy, capital flows can become more volatile, moving in and out of these countries with excessive speed. Commodity markets are another central piece of this equation. Oil, gold, grains, and industrial metals are largely priced in dollars. When the U.S. currency loses value, the nominal prices of these commodities tend to rise, even if real demand does not change significantly. This creates inflationary pressures across many economies, especially those that rely heavily on imports. In other words, a weak dollar can mean higher food prices, more expensive energy, and higher production costs in many parts of the world. Gold, in particular, tends to benefit directly from this environment. Historically, it functions as an alternative store of value when confidence in fiat currencies declines. A falling dollar strengthens the protection narrative, prompting institutional investors and central banks to increase their holdings of physical gold. This movement is not only financial but also symbolic. It signals a search for safety outside the traditional system dominated by the U.S. currency. At the same time, central banks around the world begin to review their reserve strategies. For years, holding large amounts of dollars was almost automatic. Today, that choice is subject to more careful analysis. It is not about abandoning the dollar, but about diversifying risk. Even small percentage changes in global reserves are enough to generate meaningful impacts on currency markets and international financial flows. Another important effect appears in international trade. A weaker dollar makes U.S. products more competitive abroad, which can benefit American exports in the short term. However, these gains may be offset if political and fiscal instability undermines the confidence of trading partners. Companies that depend on global supply chains need currency predictability to plan investments, contracts, and production. When that predictability diminishes, decisions are delayed or redirected to other markets. Europe and Asia are watching this scenario with heightened attention. Economies deeply integrated into the U.S. financial system know that any prolonged imbalance in the United States can quickly turn into a global problem. Past crises have left a clear lesson. When the center of the world's financial system enters turbulence, no one is completely immune. Within the United States, the dollar's decline also produces contradictory domestic effects. While some export-oriented sectors benefit, consumers feel the impact of higher prices for imported goods. This puts pressure on inflation at a time when price control is already a challenge. If inflation regains momentum, the Federal Reserve faces a difficult dilemma. Keep interest rates high to contain prices and risk slowing the economy, or ease monetary policy and risk further weakening the currency. This dilemma becomes even more complex in an environment of political pressure. Any decision by the central bank, institutional conflict, a breach in central bank independence, or a geopolitical event that forces major economies to drastically reduce their exposure to the U.S. financial system. In such a situation, the dollar could experience a more rapid depreciation, accompanied by strong movements toward alternative assets. Gold, other strong currencies, and even new financial instruments would gain ground as stores of value. Global markets would enter a period of heightened volatility, with direct impacts on credit, international trade, and economic growth. It is important to understand that crises of this nature do not emerge out of nowhere. They are preceded by years of ignored warning signs, delayed adjustments, and political decisions made with excessive focus on the short term. In this context, the weakening of the dollar acts as a thermometer. It does not create the illness. It merely reveals that something is no longer functioning as it once did. Another central element in future scenarios is the role of confidence. The global financial system is sustained less by absolute numbers and more by shared expectations. As long as the world believes that the United States has both the capacity and the willingness to honor its commitments, the dollar will remain relevant. The problem arises when this belief begins to be questioned not by external adversaries, but by investors who have historically been the strongest supporters of the American system. Moreover, the transition toward a more fragmented monetary world tends to be turbulent. Even if the dollar remains dominant, the simple fact that other assets gain space reduces its margin of safety. Small shocks begin to have larger effects, as the system no longer relies on a single, uncontested anchor. This makes the global environment more sensitive to political, fiscal, and geopolitical crises. On the domestic front, the long-term effects are also significant. A structurally weaker dollar can alter patterns of consumption, investment, and savings in the United States. Imported goods become more expensive. External purchasing power declines, and inflation may become a recurring issue rather than a temporary episode. This directly affects the American middle class, historically one of the pillars of the country's social stability. The most delicate point is that none of these scenarios is entirely mutually exclusive. Reality may combine elements of all of them. The dollar may undergo a controlled correction in the short term, while facing prolonged instability in the medium term, with the risk of episodic crises depending on specific events. This complexity makes reading the current moment even more challenging. What is clear is that the world has entered a phase of greater sensitivity to the behavior of the U.S. economy. Decisions made in Washington now reverberate with greater intensity and less tolerance for error. The margin for improvisation has narrowed, and when the room for error shrinks in a system that is so large and interconnected, the consequences of poor choices become potentially greater. Economic history shows that global currencies do not lose relevance overnight. They weaken slowly, tested by successive crises, until the cost of sustaining them becomes too high. The dollar has not yet reached that point, but recent signals suggest that it has entered a testing phase, perhaps the most complex since the end of the gold standard. I speak now not as a political commentator, nor as a short-term analyst, but as an economist who has followed the American economy for decades, who has studied its cycles, participated in academic debates, advised investment decisions, and observed from the inside the construction and the gradual erosion of the United States' economic credibility. The recent weakening of the dollar does not surprise me. What concerns me is not the decline itself, but what it reveals about the current stage of our economic and institutional system. The dollar was always strong not only because the United States was productive or innovative, but because the world believed there was a structural commitment here to stability, predictability, and macroeconomic responsibility. That belief allowed the country something no other nation ever had: the ability to borrow in its own currency without facing immediate market punishment. For decades, we treated this almost as an acquired right. Today, we are beginning to pay the price for that complacency. As an economist, I see the current depreciation of the dollar less as an isolated event and more as a delayed adjustment. The market is reacting to years of accumulated imbalances: chronic fiscal deficits, rapid growth of public debt, excessive reliance on external financing, and the increasing politicization of economic policy have created an environment that is unsustainable in the long run. The dollar is merely reflecting this reality. Donald Trump's return to the presidency has intensified these tensions, but it would be intellectually dishonest to attribute the problem solely to him. Trump did not create the deficits, did not invent political polarization, and did not initiate the process of institutional erosion. He is, in fact, an accelerator of trends that were already underway. His presidency exposes, more starkly, vulnerabilities that were previously masked by artificial consensus. From an economic perspective, what is most concerning is not political style, but unpredictability. Markets operate on expectations. Investors accept risk when they can measure it. The problem arises when fiscal, monetary, and regulatory decisions become excessively dependent on short-term political disputes. This increases the risk premium required to finance the country. A weaker dollar is a direct consequence of that dynamic. Another central point of my analysis is the relationship between fiscal policy and monetary policy. For a long time, we relied on the Federal Reserve as the system's great stabilizer. Whenever the government overspent or made mistakes, the Fed stepped in to contain the damage. This arrangement worked as long as the central bank maintained independence and credibility. Today, that independence is under constant attack. And when the market begins to doubt the Fed's autonomy, the impact on the dollar is immediate. The recent inflation surge was a turning point. It showed that there is no free lunch. Years of aggressive monetary stimulus, combined with unprecedented fiscal expansion, produced effects that many economists warned about, but few wanted to hear. When inflation returned, confidence in the system's ability to self-regulate was shaken. The dollar, as a mirror of that confidence, reacted accordingly. As an American economist, I must also acknowledge a collective failure within our profession. We underestimated the impact of political polarization on long-term economic variables. For years, we treated institutional disputes as noise. Today it is clear that this noise has become a signal. Governments that cannot build minimal agreements to manage budgets, debt, and economic policy lose credibility, regardless of the size of their economy. The weakening of the dollar also reflects changes in the world itself. The United States is no longer the sole anchor of the global system. Other economies have grown, diversified trade relationships, and developed alternative financial instruments. This does not mean the dollar will be replaced, but it does mean it is no longer uncontested. For an economist, this shift is profound and structural. Domestically, I see an additional and rarely discussed risk: the normalization of deficits. Fiscal debate in the United States has become shallow. Spending more is politically easy. Cutting spending or raising taxes is politically toxic. This imbalance undermines the system's sustainability. The market understands this. The dollar understands this. My view is clear. The dollar is not collapsing, but it is being tested. And tests of this nature tend to separate resilient systems from fragile ones. We still have time to correct course, but the margin for error has narrowed dramatically. Global confidence is not infinite, not even for the United States. The greatest risk now is not an immediate crisis, but the accumulation of small, misguided decisions. Every attack on institutional independence, every budget passed without responsibility, every unresolved political conflict adds weight to a structure already operating at its limits. The dollar feels this weight before any other indicator. As an economist, I do not see this moment as the end of American leadership, but as the most critical moment since the end of the gold standard. The difference is that now the world has alternatives, still imperfect, but real. And when alternatives exist, the cost of mistakes rises sharply.